we have people right now, for example, have a little bit issue of being asset rich, having assets that appreciated quite a bit, not necessarily extremely cash rich. Basically means real estate investments, stuff like that, where there's quite some asset value, but it's not that easy to actually move those investments into a different type of vehicle or asset class. But as you guys know, we're not big fans of asset class in general anyways. Asset classes in themselves are not really performing well if you put them into an index in general. So we like to take a very approach and just say, okay, what is best wins? But that's just on the side. But with that kind of idea, we're basically running a lot into issues that people that get the idea, okay, right now, real estate market is pretty much at a higher end, and it's a good time actually to liquidate some of the assets, but when are you doing that? And that's not only with real estate, we also have situations with people that had like big one-time liquidity events, right? And then, okay, so what are you doing with that? And most people are not super excited of paying like 40% or something around that to the IRS when things like that happen. So if you would buy, let's say, for example, you would sell the building. Let's say you have you have a building that is worth $1 million, $50 million, $20 million. And you can obviously always do a 1031 exchange. But then the issue is mainly that because the market is so inflated that you can only buy something that is also inflated, right? So where's the benefit of it? So for lots of, there's this situation that they say, okay, my investment did great, but it doesn't really help that it did that great, because if I sell it and then buy something else, I will either buy something else that is also where basically the gains are not really materializing because you're buying something else that is overpriced through a 1031 exchange, or an in-kind exchange of any other kind of asset. If you're selling your company and you have a big liquidity event, then you, in either way, if you don't put it back into something similar, you have the issue that you're paying a big tax bill, right? What is the solution for that? In general, and some of you guys already saw some of that on some of the last calls. I was in this whole framework of working with family offices, and with family offices, you're probably aware of that they're using lots of nonprofit and charitable structures and so on, and then different vehicles to make sure that you're basically not personally taxed right away, and that you're also not having huge taxable events, the estate, and so on. So how do you do that? Normally people come in with structures that are already there, but the idea would be in basic terms, if you want to get out of the scenario that in case of liquidity events, immediately get hit with a uncomfortable tax bill, you should obviously plan ahead, right? And in the family office world, people are planning pretty well ahead, and very often over multiple generations. But we see that with, especially like with entrepreneurs, people that kind of build their wealth more recently, the horizon is a little bit too short. It always depends on the individual situation of the person and what other pieces are involved, but it's definitely doable. In general, there are those elements that we touched on some of the last calls that are the known elements in a sense. One thing that is always part of it is a concept that, let's just, as a placeholder name, we would call it Freeze LLC. So what is the purpose of the Freeze LLC? The Freeze LLC is basically, it's a made up term, right? It's just that you create an LLC where you have common units and preferred units. You can see that here. The preferred units are owned by a charitable organization, or there could also be scenarios where you have your own charitable organization. It could also be a pooled income fund. There are different ways of charitable vehicles that could be the owners of the preferred units, and they own 99% of the LLC, but it's just the preferred units that are basically like a bond, right? It's like type A shares. That in the end, it's named in a different way, but they basically look and act like a bond, and that's what the charitable organization will own. But they basically don't really have control over the LLC, and although you just own 1% of the LLC, all the common units are basically contained within those 1%, and with that, all the control. And then all the assets are getting donated into the charitable organization, into the setup, and then wrapped into a PPLI. So what does that do is, within charitable organizations, you always have obviously the issue that if you're doing any business activity that is not in line with the purpose of the charitable organization, then it's unrelated business activity and it's a taxable event. But if you wrap it into the PPLI, it becomes a UBIT blocker, like this unrelated business activity. And with that UBIT blocker within the PPLI, you can invest into whatever you want, at least the type of PPLI that we would utilize. And the PPLI, which is private placement life insurance, is also not tied to one person and the structure or whatever. It actually is a chassis that uses multiple people as beneficiaries, and those people have nothing to do with anyone who's basically building this structure. So the private placement life insurance is basically just a shell that is getting used. And there are obviously like death benefits and all those things, but it's 100% reinsured. So it's really mainly to use those lives if you want so to have the PPLI wrapper set up. And let's say you are insuring like 30, 40 different lives inside this kind of group chassis, and they are like 30 years old now. The policy will basically stay alive as long as at least one person that has been put into this insurance is still alive. Could be like 50, 60, 70 years or whatever. So you have a pretty long life cycle of that whole structure. There are multiple ones. There are offshore ones. There are domestic ones. There are ones that are group chassis. There are single lives. We would need to define that with every client one by one. There are obviously like 2 or 3 that we would use, but there are about 65 providers or whatever. And we would use the one that makes the most sense for that setup. Not in all setups you can use the live chassis also because of volume. You need to be at a certain volume for that to make sense. Yeah, but those are also things that we would discuss under NDA with people once we actually get into an engagement. So the PPLI will basically hold all the complete asset base. So if somebody, for example, owns a business, you could put everything that you own into the structure, right? Like it's not just like your stocks and your usual investment. You can basically put everything into the structure, including if you own a business, you would put the business into it. And then if you need to pull out income out of the structure, so let's say, for example, even if your business in there, you would just take out loans against the PPLI asset value in a sense, or the PPLI spins out cash, and then you can loan out the money to whoever it would want to. And if you're taking out a loan, that's not a taxable event. At the end of whatever time frame that is defined, probably it could be once the person who's basically building the structure dies, the PPLI will pay off the loan. So there's not even like a taxable event at that point. Like if you forgive a loan, it would be a taxable event. But if the loan gets paid off by the PPLI, there is no taxable event. So this way you can even move your tax liability to almost 100% into the structure. It's pretty elegant. Obviously the biggest challenge here is it's quite a couple of moving pieces on the other side, and you have to plan ahead quite a bit. But especially for people that own companies, where obviously you're working all your life to basically build the value of the company, then at some point you might want to liquidate it, or you might want to pass it down to family. If you don't have a structure like this in place, the issue is obviously there are taxable events. Like even if you would just pass over the shares to employees or whatever it is, there is a value of the company, and based on the value of the companies, it's going to be a gift that will become a taxable event. It's wrapped into structures like this. So that's why I believe everybody should know about structures along these lines and get informed. And even if like people don't really think that they are that big of a deal in terms of how much assets they have or whatever, pretty often, like we just talked to a few people where they were like, yeah, in terms of like cash to invest, it wasn't that big of a deal. But on the other side, they had a business that was actually doing pretty well, spinning off quite some income every year. And then if you take an EBITDA multiple that is even like conservative, all of a sudden there were quite a bigger deal than they thought. And all of that would go into the structure. Instead of pulling out $500,000-$600,000 a year in income that would be taxable, it would just be turned into a scenario that I just described, where you're pulling out a loan. And in this structure, you could also be like a manager of those entities and pull out some income so that it's not looks too impossible. You could pay yourself like 70, 80 grand a year in salary for some basic things, and then deduct whatever you can out of that so that you have some income that is just like covering the basis, and everything else gets pulled out through those loans, right? In general, as I said, this structure, it's just an example of what it could look like. But in structures like that, the way that it would basically be set up, they're about $4 billion, and that we basically, and the people that we work with are managing. And interesting thing is obviously we combine it with Ben's investment philosophy. As an example, I have the 8% fixed income product. And now you basically have an 8% fixed income product that is basically tax-free. Not even just tax on capital gains, but it's literally, we can get it down to completely tax-free gains. Then there is nothing that can beat it. So you would basically have a fixed income instrument like the IO5 fixed income product with a 8% effectively guaranteed, 2% kicker, and so on. And you build it into this structure. It basically becomes a tax-free 8%. Then you can decide if you want to roll it over every year or to just get contributions. And the contributions obviously are happening inside the PPLI. You can decide if you pull it out or not. So it's very interesting because it's percent either income or capital gains taxes. And if in terms of performance, obviously, if you compare it to other products in a similar category, it's definitely a couple of times better than that. And all those others, if you don't have it wrapped into a structure like this, would carry obviously some tax liabilities as well. So you're not using the assets in the PPLI as security. The PPLI can just basically loan out money that is in cash inside the PPLI. You would reduce the amount of money that you have in the investments by pulling out cash, but the PPLI can just lend you the money. So let's say, for example, you have $10 million in there. You want to borrow $1 million, then you would basically not invest the $1 million in a structure like this, but only invest 900,000, and the $1 million would become the loan out of the PPLI, right? So you would not necessarily collateralize it, you would just take it out. There's also ways that you could collateralize it, but that's not even necessary in this case. So in the end, obviously, if you would just put illiquid assets into the structure, there would be some that would need to be liquidated, or they would need to be in strategies that are more liquid, which we also do, right? And then this way you can pull it out. But let's say, for example, the product would push out 2% a year on $1 million, 2% a quarter on $1 million. That would be like 20 grand every quarter. In theory, you could use that cash that is getting distributed and lend it out whenever the cash is available, right? It's as easy as that. So you don't need to collateralize anything. And even if you would use it as a collateral, it would only work with very specialized lenders. If you would want to use the PPLI assets as a collateral, because obviously it would be owned by the policy and so on. Anyways, but that's not even the issue, because you will have cash in the policy that you can just use for it. It would just reduce the principal basically that is creating the returns. That's, as I said, like normally also not the big challenge, because we're creating a lot more in returns. So I'll just summarize the structure one more time, just to make sure that everybody will also dial it in a little bit later. So the idea of this whole structure is obviously, okay, so if there are bigger transactions, bigger liquidity events, how can we eliminate like the immediate taxable events? So if let's say you had property, like in one case, Jeffrey, like in Don's case or whatever, right? So you would have, he had a property for many years, 20, 30 years, lots of capital gains, right? If he would then just go and sell the property, which is a good moment, the cap rate is pretty compressed, he can get a lot of money for the property. But if he would just sell it, then he would need to reinvest it through a 1031 exchange into another property that is similar to his. There would not really be any win for him, because then he would also invest in the same cap rate compressed environment and would not really gain a lot. On the other side, if you could basically sell the property, reinvest into something that is creating bigger returns at this moment, it would be nice, but then you would have a 40% tax bill, and then those bigger returns would need to be like crazy big for the 40% loss by not doing a 1031 exchange to make up that gap, basically. And that's why, for example, you don't really see as much selling activity in the real estate market when people actually should sell, just because what are you going to do with those capital gains? So in lots of those cases, the way to go is basically that everything that you have goes into what we call this freeze LLC type of setup. 1% of the companies in common units, 99% in preferred units, and then the 99% preferred units are owned by a charitable organization, right? But because they're preferred type A units, they basically act like a bond. They just get some LIBOR fixed distribution. The common units are basically participating in all the growth. And then to make sure that all the assets that are in the structure can be reinvested in whatever way possible that would yield the best returns, all this kind of asset base is getting wrapped into a private placement life insurance that allows especially if it's a bigger amount, you should have a group chassis with multiple beneficiaries. Then also basically freedom on how inside the private placement life insurance your assets are going to be invested. And with our clients, obviously, we would be the investment managers of those assets, and then they would go either into most of the time into some guaranteed fixed income scenario, like here with the 8%, or they would go into some growth products or whatever. Like we will manage it in a way that makes the client happy, the way that you would manage it and in any other case, just that you can basically create the setup in a way that wouldn't incur capital gains or income taxes because it's in this wrapper. So this is basically what this structure in broad strokes does. If it's a group chassis, there's no medical underwriting for anyone who's involved here providing this whole thing and setting up the setup, because that is not the person that is getting insured, right? In the group chassis, you're taking some 30-year-olds, and that's why the structure will survive for 60, 65, 70, 80 years. So you're insuring some group of 20, 30, 50, 30-year-olds, very often public jobs or whatever. It's basically have access to enough lives that will be provided, that will be insured of young enough people. So the medical underwriting is not an issue. This is a vehicle that is really developed and designed for the purpose of what I just described. You're not going to have a death benefit or anything yourself out of this setup. If you want that, you will need to buy some real life insurance. This is not what this is. And as I mentioned, there are structures like that managed by the latest quantitative asset management based on Ben's work. What we usually put in there is like the 8% net income, as I said, with zero capital gains and zero income taxes, just based on the wrapper that you see here in the structure. And normally, obviously, the structure is getting used for people that are like 25 million and up. We have a way to do that for people that are a little bit lower as a single setup, $5 million and up. And we also ways to group it, right? So if we would have a couple of people that have 500,000 to $1 million, we can basically set this whole setup up, and then the common units are just owned by a group instead of by just one person. So we would be able to basically set up a structure that is normally like the $100 million plus category that sets up structures like that and make it available for people, let's say, $1 million and up. I think that's pretty attractive. So and the $1 million and up could include businesses that people own. So if you put that into the equation, there are lots of people that would definitely be qualified to do anything like that. I think that's all I have for today. I just wanted to quickly walk through that. I think it's pretty exciting and compelling to look into structures like that. I think it's basically everybody should know as much as possible about structures like that, and nobody gets educated on that. And that's obviously also for a reason. And we're just trying to change that to a degree and open that up to more than just the billionaires out there that don't need our help. But I think there are a bunch of people that would love to learn more about that. The problem is obviously very often people, like, their net worth grows over time, and then over the time they just keep doing what they did in the beginning, and nobody's really pointing them towards better solutions, because also like their CPAs or whatever, they grew with them and they're just filing taxes like they always did. And I don't know anyone who got a call by a CPA who said, we're going to change, we have to change the whole structure. Like, it somehow doesn't happen. It always needs to somewhat come from the outside. So anyways, that's what I have for today. I hope there was some good stuff in there. All right, have a good weekend, and thanks for joining.